Welcome back, and thank you all for joining us for the afternoon sessions of the Joint Mutual Forum. My name is Mike Brickman, and I'm the Deputy Controller for Thrift Supervision at the OCC. I hope you all are enjoying the forum so far. We've got a great afternoon planned for you as well. In addition to the update by the Federal Reserve that I'm about to introduce, this afternoon session includes two interesting panel discussions. The first is a panel of your mutual peers who will talk about the benefits of mutuality, and the second panel will walk you through what your management team should do when faced with a ransomware or other cyber event. We hope that you'll continue to engage in the discussion through the question and answer box available to you as participants. As a friendly reminder, if you'd like to activate the closed caption function, please click on the three dots in the lower right corner of your screen and then click on the button that says Multimedia Viewer. And I would like to remind you that this event is being recorded and will be available on the FDIC's Mutual Institution webpage in a few weeks. So with no further delay, I'd like to introduce the legal and supervision representatives from the Board of Governors of the Federal Reserve System. You can find their biographies in your packet. So I present to you Attorney Nathaniel Balk, Special Counsel Keisha Patrick, Senior Counsel of the Federal Reserve's Legal Division, Vicki Civillo, and Trevor Gaskins, who is the Lead Financial Institution and Policy Analyst in the Community Banking Supervisory Oversight Group. I'll turn it over to you, Trevor.
Thank you, Michael. And thanks, everyone, for joining the session. We appreciate it. So first, I work in, my name is Trevor Gaskins. I work in the, what we call the Community Bank Oversight section, which is responsible for overseeing the supervision of community banks throughout the Federal Reserve System. We obviously also support, the development and implementation of regulatory policies for community banks. I also have experience in the regional bank, or sort of like a 10 billion sort of mid-sized section as well. So just to give you a little perspective on that. But wanted to obviously provide this opportunity for an update, mainly on sort of supervision matters that we believe are more sort of, I think, specific to the audience, which is obviously would be mutuals. And so that's going to be our focus today. We're going to try not to regurgitate some of the information you've heard already, because obviously the Federal Reserve, OCC, FDIC, we work together, particularly in supervision. And so a lot of the issues you're going to see on their end are going to be some of the things we're seeing on our end as well. So, I'll try to stick to more specific, impacts for mutuals. And, if there are any questions, obviously we can address that in the Q&A. And we're hopeful that there is, some good questions, for us. So, with that, what I'll do first is I will start with where things are relative to the supervisory posture. And again, before I start, I'll say that I'll do this disclaimer. Everything that we're saying today, obviously, are our own opinions and don't necessarily reflect those of the Federal Reserve. So with that out of the way, I will start off with the pandemic supervision and posture. As some folks may understand, the agencies, meaning the banking agencies, released sort of pandemic sort of relief guidance, you want to call it, which really would provide flexibility, essentially work to provide clarity and flexibility as to our supervisory stance during what is an unprecedented time, right? And so we believe, we're going through the process of sort of reviewing how that has been going, to be able to provide more of a summary on that. And, to say it looks like, at least between interagency coordination, and with working with bankers, at least relative to, providing flexibility, it looks like it's been positive. I could say relative to mutuals. So for the Fed, we primarily supervise mutual holding companies. We have about 140 or so mutual holding companies, most of which are bank holding companies, probably about 75 bank holding companies, about 57 or so thrift holding companies. So you have a good mix of holding companies. Obviously, most I'd say virtually all are community bank size in nature, under 10 billion in assets. So true community banks. Through that supervision program, obviously for community banks, we focus efforts on really high risk activity. We try to focus our work on firms that had higher risk profiles. and where possible, obviously try to work to reduce burden in terms of requests and sort of exam activities where possible to allow time for obviously bankers to sort of adjust to this new normal. So that was the approach. We obviously took the same approach with the mutual holding companies. Most of our holding companies are, like I said, they're small. Most are shell holding companies, meaning that there is not much, if any, activity going on at the holding company level. So the procedures are relatively minimal. We do have about 24 or so state member banks that are mutuals that are all housed out of the Boston Fed. But generally, our assessment of them has been it looks like they're all sound, relative sound condition, and have maintained sort of resilience during the pandemic. Many are well capitalized, and obviously there is some commercial real estate concerns, but generally, our opinion so far is that the bankers have done a really good job of managing the balance sheet and generally working with their borrowers. We did see quite a bit of our mutual banks and holding companies taking steps to work with borrowers and support their community. So definitely kudos to you all. So one thing I'll note relative to sort of any issues we've been seeing relative to supervision, we haven't really seen anything that I would say that's different from what we'd see at traditional community banks in terms of issues. Obviously, as mentioned at an earlier presentation, we are seeing a tightening of the NIM, obviously due to sort of certain economic factors. Obviously, in areas where I'd say more closer to sort of metropolitan or where you're having sort of more issues and valuations, we're seeing, there's obviously some deterioration there, but generally, the mutuals, at least under our supervision, are not necessarily located in areas with that have seemed to have had the economic impacts that others have had so far. So with that, we are seeing obviously the issues that we're seeing relative to sort of corrective actions, or you want to call MRAs, have been more focused on, I'd say, policies and procedures, are more around sort of like credit risk management. But again, these issues are not, I would say, specific to problems we're seeing in the pandemic. We have seen the firms do a sort of a sound job of monitoring their participation in the pandemic relief programs, such as PPP, and any sort of access to liquidity or of that sort. We've seen the firms take efforts to try to shore up their essentially liquidity in that perspective during the pandemic. So generally, we haven't seen significant issues, but the little issues that we've seen more have been related to sort of the risk management that are more of legacy of nature, meaning they were existing prior to the pandemic. So that's really, I guess, sort of a good report. Obviously, there is concern. There is definitely concern around obviously commercial real estate. And that's something that not just us, but all the agencies are working on, and we're coordinating with the other agencies on monitoring that and the performance of that, particularly as we go later into the year and some of the moratoriums end and those matters. So I think we are we're definitely monitoring those factors. Another big I'd say concern of focus, at least from a supervisory perspective, has been the sort of the ransomware. I'd say like the cyber security ransomware. I know there's going to be a session on that later, so I'm not going to spend a lot of time on that. But it is an area of concern. Obviously, you've probably seen things in the news, relative to issues around that. And it is something that I know all the agencies are working, I'd say, partly together and also individually to sort of monitor and sort of wrap our hands around. So really, those are the key things we've been looking at relative to what the posture is going forward. Obviously, at least at the Fed, we put in, our posture has obviously been out. We have the SR letter of guidance from last summer. Generally, we're evaluating that and looking to see sort of, as we go into a new normal, what what that looks like. What is our posture going to look like? And obviously, we're working with the other agencies in unison, so there's not some significant divergence in how we're approaching it. But generally, there is going to be sort of a review of what's worked and what's not worked, and what can we keep from the posture and what we can't, and maybe what should remain. I can tell you one thing in particular is, through supervision, obviously, there's been a lot of offsite work that's been done. And so as part of that, there's potential for gaining efficiencies on doing more, offsite work, potentially, having maybe less of a presence sometimes at the banks, depending on their space. We have heard sometimes that space is an issue. So again, these are things that are being evaluated, and there'll be, obviously more communication on that, I'd say, over the coming months going forward. I do know from a community bank perspective, there will be a communication as to that, sort of the ongoing posture, and that will be forthcoming. I cannot tell you the date necessarily, but I know that it will definitely be forthcoming. Relative to what the Fed is doing for sort of return to work, again, that is something that is being evaluated. The board and the reserve banks, they do work, sort of coordinate, but generally the reserve banks sort of have their own sort of structure as to how they operate and how they conduct exams. So the decisions and the timing on when folks at the Fed will be, let's say, back in their office per se, or maybe doing more normal activities, I'd say will be subject to maybe the reserve bank or sort of the supervisor at the particular reserve bank. But generally, I would say there is work being done to evaluate that, and depending on particularly if you have a mutual or holding company who your supervisor is, they'll communicate sort of where that stance is. So with that, one other point I would note is we do have some sort of pending or outstanding policy issues that I know sort of are near and dear to sort of the mutual banking space. We do have, obviously, for the thrift space, we have our Reg LL, which is sort of dictates the sort of the regulations around for the Fed for thrift holding companies. We also have Reg MM, which does similar for mutual holding companies. And so those policies are policies that are interim final, and they're policies that are obviously under review with the Board of Governors. So it is something that is in process. Obviously, with the pandemic, that has obviously created a little delay on that. But generally, that is something that is in process and has been being talked about. Another thing we understand is there are questions around sort of the MDI, sort of the recent guidance around MDIs and capital treatment for mutuals. Again, that's another thing that is on the governor's desk. That's being reviewed, and hopefully there will be communication on that from them shortly. And also, I know our legal folks will talk a little bit about covered savings associations, which also impacts primarily, obviously, the thrift mutual holding companies. And so that is something that's also being discussed, and legal will touch on. So with that, I think I will move it on to Keisha or legal to maybe discuss a little about some of the policy initiatives going on the legal end.
Thanks, Trevor. So I'm Keisha Patrick. I'm special counsel at the Federal Reserve Board Legal Division, and Nate Balk and Vicki Cipillo have joined me today. We're just going to talk a little bit about covered savings associations, and we're willing to take your questions on that topic or anything else you'd like to ask us about mutuals. I think our presentation actually will be pretty brief. At the beginning of 2020, shortly before the pandemic started, we received 2 requests for determination regarding how the Federal Reserve would treat grandfathered unitary savings and loan holding companies whose depository institutions make elections to become covered savings associations. Unfortunately, because of the pandemic, we were a little delayed in responding, but on April 1st, the General Counsel issued an interpretive letter in response to those requests for determination. And I think the takeaway from the letters is that For all Federal Reserve purposes, covered savings associations will be treated as national banks. And as a result of that, the holding company of covered savings associations would be treated, would become bank holding companies. So what the General Counsel did, and I'd like to assure you that it's a General Counsel interpretive letter, but as you may know, with things at the Federal Reserve and other government agencies, it left with the General Counsel's signature only after it had been reviewed at every level, including those who have selected who the General Counsel will be for the Federal Reserve. So I just wanted to share that, you know, as the legal division and others in the Federal Reserve took a look at the statute, took a look at the statutory history, the legislative history, but what we discovered was that the goal of the Covered Savings Association, from our understanding, was to create a flexible charter. And so, based on our understanding of the statute as drafted and of the legislative history, we thought that the best outcome would be the appropriate interpretation. I'm sorry, not best thing. The appropriate interpretation is that the statute was drafted to treat federal savings associations that make this election as national banks, except for the limited purposes outlined in the statute. There are limited exceptions in the Economic Growth, Regulatory Relief, and Consumer Protection Act, for which covered savings associations would continue to be treated as federal savings associations. And we are now, based on our interpretation, requiring that firms that make the covered savings associations elections become members of the Federal Reserve System. Covered savings associations will be treated as national banks for purposes of Sections 23A and 23B of the Federal Reserve Act. And for competition purposes, as we review applications filings, mergers and acquisition filings, covered savings associations will be treated as national banks. And again, for holding company purposes, parent companies of covered savings associations will become bank holding companies. We thought that this was the most consistent with the statute, because if we allowed some other option for a holding company, if the holding company were to remain a savings and loan holding company, some kind of hybrid, strange holding company would result, and we didn't believe that that was the intent of the legislation. So the outcome is that firms that have already made this election, it would be probably good to reach out to your reserve bank about becoming a member of the Federal Reserve System if you haven't already. Firms that have holding companies, mutual holding companies, that would mean relinquishing your federal charter and becoming a bank holding company and getting the appropriate state charter for your mutual, and grandfathered mutuals, because they're becoming a mutual holding company, a bank mutual holding company would no longer have the HOLA status of grandfathered. So that's basically the thing that I think that has impacted mutuals the most since we last had one of these forums. So we just wanted to talk a little bit about how covered savings is, how this interpretive letter impacts mutuals. Specifically, I think mutual holding companies, the biggest thing is just a relinquishing of that federal charter and setting up a bank holding company and the appropriate state charter for a state mutual if you're continuing on that route. And if it's a grandfathered mutual, of course, becoming a bank holding company means that you're no longer subject to HOLA, and that grandfather status is only under HOLA and not under the Bank Holding Company Act. So with that, if there are any questions that you have about how we'll treat mutuals that are CSAs, mutual savings associations that make the CSA's election, or mutual holding companies whose depository institution makes the CSA election, feel free to enter those questions into the chat. Nate or Vicky, is there anything that I did not include that we need to bring up?
Nothing to add on covered savings associations. Thanks, Keisha.
I think you covered everything. Thanks.
Okay, thank you. So that's what we thought was the most significant update in our treatment of mutuals. And as Trevor said, we are continuing to look at regulations LL and MM. Things did slow down because of the pandemic, but they are on our agenda. And likewise with covered savings associations, we expect that we will have something that we'll work on something that would kind of be like give a little bit of guidance or formalize a little bit more guidance to you on moving forward with contacting your reserve banks and things like that. Okay.
Thank you, Keisha.
It looks like I have a question, and it says, let me see how I can make the question bigger.
Oh, please touch on the okay. Please touch on the Fed's view of the QTL test. Okay, as it pertains to covered savings associations.
Hold on, let me see. Okay. Please touch on the Fed's view of the QTL test as it pertains to covered savings associations. So the QTL test as it pertains to covered savings associations is something that is at the bank level. What we're looking at is at the holding company level. Once someone makes the covered savings association election, they have elected to be treated as a national bank. And so if you've elected to be treated as a national bank, then your holding company is a bank holding company. So the QTL test is something for at the bank level. And for these purposes, if you have the ability to not meet the QTL test and because you're a covered savings association, whether you're meeting the test or not, you've elected to be treated as a national bank. So that's the interpretation. You've elected to be treated as the national bank, whether you have decided to no longer satisfy that test or not. Someone asked, will we send out formal guidance on this subject? We are looking into something that we can draft that will give a little bit more guidance, but to be honest, I think it will end up just being a cheat sheet of what's already in the interpretive letter. The interpretive letter, wasn't drafted to address mutuals, but I think that the guidance in there equally applies to mutual organizations. That if your depository institution makes the election, then the holding company has to follow, as well as if you are a mutual savings association that makes the election, then you also have to become a member of the Federal Reserve System. And the other implications that apply to non-mutuals apply to mutuals as well. Any other questions? Okay. Do we have a timeline when the Covered Savings Association guidance will be made available? Unfortunately, I do not have a timeline on when the guidance will be made available. We are pushing forward with it. One of the challenges, as you all know, even in the things that you're doing, is that now that the pandemic, now that we are transitioning back into whatever our new normal is becoming. There are a lot of things that that we are trying to ramp up that were not necessarily the priority during exigent circumstances. So now that we're not under exigent circumstances, there are things that we are looking at and that we're trying to push a lot of things forward that weren't exigent when the pandemic began. Because of the pandemic, and we're trying to move this forward. So we are moving it forward. I don't know the timeline because now we're leaving the exigent circumstances and able to focus more on all of the things that are on our plate generally. I don't see any other questions.
Okay. Well, thank you, Keisha. Yeah, I'm going to see for questions as well. I know at least from a supervision perspective, obviously for mutual holding companies, if obviously the CSA will, they'll be treated similar to BHCs, right? So they'll fall under sort of that review. In terms of how they're supervised from a community bank perspective, it's very similar. So I wouldn't say that there are significant differences in the approach between the two types of holding companies, but obviously because of the different powers that each sort of holding company is allowed to engage in, then there are obviously differences there, and so those will be things we will check, and obviously the regs will be different too. So there are differences relative to checking that, but just from a pure sort of operational supervision perspective, you wouldn't see significant change. Just more so on what we're focusing on relative to regulations. With that, I think I don't see any other questions here unless someone else sees them. I know I haven't necessarily seen all the questions. One other thing I would note, so I'm not in the application section, so I'm not able to give you all the details around applications, but I can give you a little color based on my understanding of application activity relative to mutuals, at least over the last year. It looks like we've had roughly 5 second step conversion applications, and looks like roughly two acquisitions. So I guess not a ton of activity, but we obviously are seeing conversions go through. We are seeing mutuals convert to BHC. So that's a trend we've been seeing over the last few years. So that's not, I would say, surprising. But nothing in particular from a supervision applications perspective highlight. I don't know if legal has anything relative to applications that are worthy of note.
I think one thing we didn't talk about, that I'll briefly mention, is that we have seen post-conversion savings and loan holding companies being acquired by credit unions, and we've had, for the first time in the last year, firms whose liquidation accounts were distributed because they were purchased by a credit union. So I think that's another significant development in the mutual space that's occurred during the pandemic. There was one. I see another question about waiting on the guidance concerning covered savings associations and what to do in the interim. In the interim, your guidance are the 2 interpretive letters that are available on the board's website in response to the request for determinations that we got from John Deere and from Auto Club Trust. Those very clearly provide guidance on how the Federal Reserve will be treating, or is now treating, covered savings associations. So if your firm has already made that election and now since April 1st, you haven't reached out to the Reserve Bank for which your covered savings association sits in that district, then you need to reach out, because you need to take your membership duties seriously. If you have a holding company, if your firm is a holding company of a covered savings association and you haven't reached out to the Reserve Bank to say, hey, we made this election, we're being treated as a bank holding company now. Now's a great time to reach out. April 1st was a great time to reach out. Now's a great time to reach out. We're not saying at this moment now we are implementing the interpretive letter, and I don't know what the end result the guidance what it will look like, but it will probably kind of take the interpretive letter and say, question, what's the status of a holding company whose depository institution has made a covered savings association election? Answer, it's a bank holding company. So that's already in the interpretive letter. It's just going to be a document that is probably, this is my imagination. We have not sent anything upstairs. But what I'm expecting will happen is it's going to just be a document that, breaks down that letter a little bit more plainly, outside of, the specific request that John Deere had, but John Deere's request pretty much covered the questions that we had been hearing. Like I said, we had two requests. One was from John Deere, one was from Auto Club Trust. John Deere asked more questions than Auto Club Trust, so that letter is more fulsome. It's the better letter to read and to go by. You should read both of them. If there's something that is missing, perhaps it is in the Auto Club Trust letter, but you should take a look at both of those letters before you make a CSA election. Or if you have already made the CSA election, then you should, if you have not, immediately, review those letters and act upon them, because we are already in a position, in a place where we are expecting covered savings associations to become members, to comply with 23A and 23B, and for their holding companies to be bank holding companies. If you are a mutual holding company of a covered savings association, then we're expecting to receive something from you relinquishing your federal charter and establishing a state charter. Now is that time. There's no reason to wait for guidance to come out, because that's already how we interpret the statute.
All right, we're just reading the questions here. We got another question here.
Okay, hold on. Let me see. Okay, is there a possibility of unified interagency guidance on voluntary liquidation policies? I'm concerned that this could be a workaround for activist depositors and others to circumvent existing mutual bank merger rules and laws. I am voluntary liquidation policies. I think that this is something that we can raise, but I haven't come across any voluntary liquidation proposals. The filings that we have had where a credit union purchased a savings and loan holding company that had converted from mutual status to a stock institution. Those were not voluntary liquidations per se. They were required under the regulation. And at the time, we found some inconsistencies between the OCC's regulations and the board's regulations, really somehow related to however differently we adopted former OTS rules when each agency brought the rules over. And we have worked very closely with the OCC in each of those situations, resolved it so that there is consistency and clear direction for how the liquidation should move forward in compliance with both regulators. So so moving forward, especially as we begin, now we're in a non-exigent circumstances season, and as we look at Reg MM, we expect that our regulations will be consistent with the OCC's regulations and solve the really impossibility that was in both of our regulations moving forward with the liquidation accounts. That's what we're expecting to do with as we continue to review MM and make changes to it. But I don't know. I'm not sure what you mean by voluntary liquidation policies, but because I I am not aware of a voluntary liquidation that a firm has pursued.
Thank you, Keisha. I don't see any other questions here. The only thing I guess I would note relative to supervision, and thank you for that, is I was looking to see. Also, typically, I know we do get questions from this sometimes from mutual holding companies. I'm hearing some feedback. We do get some questions. We do get questions around, is there, in terms of how we view them from a supervisory perspective, is there a difference? Do we essentially acknowledge the difference between sort of the mutual model, right, to mutuality versus traditional, bank? And obviously for that, the answer would be yes, we do. There's actually training specific to mutual holding companies, supervising mutual holding companies and mutuals to help make sure that examiners understand the differences, and when they're assessed, they're obviously assessed. They're obviously compared with their peers, but also viewed from a mutual perspective. So essentially, there's making sure that you're comparing apples to apples when you're looking at mutual from a supervision perspective. Like I said, we have gotten that, and sometimes there have been expressed concern around sort of how you're thinking about measuring mutual versus sort of non-mutual. So just wanted to sort of speak to that and be sensitive to that. So it is something that we understand and respect, and the mutual business model. And so and have actual specific training that addresses it. You even find it in the bank. There are our commercial bank manual as well. You'll find some information about it. So with that, I don't see any. Go ahead, Keisha.
So Nate very kindly sent me a message suggesting that, and this is just because I didn't think of it as voluntary, that the credit union acquisitions, those liquidations are voluntary liquidations. I guess I didn't think of that. I didn't use that terminology. That terminology isn't necessarily how I've been thinking of them, because there was question when these types of transactions were initially proposed as to whether the firms would be required to liquidate. And because of that was all that's in my head. So the voluntary word wasn't, that terminology, I guess, I wasn't focusing on it. But yes, those indeed are voluntary, because of course you don't have to enter a agreement to merge with a credit union. But if you do, a credit union is not a bank. It is not part of the banking system. And that is why a liquidation has to happen. But I'll let Nate, if there's anything that you wanted to say on that, please go ahead, because I missed the terminology there.
No, I don't have too much more to add. Tom, feel free to follow up if you have sort of any specific guidance on that question afterwards. I think we're not quite getting at exactly what your question is looking for, so we'd be happy to address that offline.
Someone asked, has the interpretive letter been shared with the OCC to be shared with all institutions considering taking the Covered Savings Association option? Yes, the OCC is aware of the interpretive letter. They have copies, to my knowledge. The copies are publicly available on the board's website. I do not know what the OCC is sharing with institutions that are considering taking the CSA election. But I would think that perhaps they are, reminding firms that that the Federal Reserve has an interpretation that should be considered. I know before we issued the interpretive guidance that the OCC would suggest that firms contact us about how the holding company, when firms raise questions. And even in the OCC's final rule on CSAs, the preamble discusses what is in the Federal Reserve's jurisdiction, right? And the OCC acknowledges in that preamble that holding companies are not in their jurisdiction, the membership is not in its jurisdiction. And so for anything pertaining to the Federal Reserve's jurisdiction, the OCC has sent firms to ask us questions in the past. So I assume that they will continue to do so, or perhaps direct them to our letter. And I'd just like to add on that note, before our interpretive letter came out, when we received questions, we always advised counsel and firms that as the issues were being researched, studied, and reviewed at the Federal Reserve, that there was a 50-50 chance that that the outcome would be that the holding company would remain a savings and loan holding company, and that it would be a bank, and an equally 50% chance that it would become a bank holding company. So even before the interpretive letter came out, we have been consistent with the message that if a firm moved forward with the election, that there was this at least 50% possibility that membership and holding company status would change.
Thank you, Keisha. So it looks like, I don't think we have, I guess, does anyone have any more questions? We're definitely open. We only have about 3 minutes left, so maybe have time for one more question if anyone wants to put in the Q&A box.
Thanks, Trevor. I just spotlight that also Mike responded to Joe in the Q&A there, and I'll just read it out for folks who aren't following, which is just that the letters are public on our website, and the OCC also is continuing to redirect any questions on the interpretation to us. So.
Thank you, Nate. Okay, we're not seeing any questions. So, yeah, with that, I think that concludes sort of our points. Like I mentioned, I could say, from a supervision perspective, when it comes to our sort of community banks, there will be communication coming out relative to the Fed's posture and sort of what the thought is moving forward. And obviously, as part of that, there's communication we're coordinating and communicating with the FDIC and OCC sort of on that supervisory approach. So obviously to make sure there's some level of consistency and that there's no surprises as we sort of roll into a more normal or a new normal. I'm not sure what the terms are these days, but it's a new normal stance. So I think with that, we are wrapped up. Michael?
Yes, thank you, Trevor and Nate and Keisha and Vicki for sharing with us some of the updates on what's going on over at the Fed. For those of you who are just joining us, we're going to take a brief 5-minute break in order to set up the next panel discussion, so we will return momentarily.